Something big is stirring in the precious metals market, and it assesses the kind of development that doesn't politely knock before it enters the room. If you own silver, gold, or even if you've just been casually watching from the sidelines, this is one of those moments where ignoring the signal could come back to haunt you later. What's unfolding right now isn't normal price action. And according to Francis Hunt, it's only the early stages of something far more dramatic. Hunt recently laid out a scenario that at first glance sounds almost unbelievable, but once you slow it down and follow the logic, it becomes far more unsettling than sensational. He's warning that the long-standing relationship between gold and silver prices is breaking apart. Not drifting, not adjusting, but potentially collapsing into territory that most investors alive today have never seen. And if that happens, silver prices won't simply rise politely, they could explode. Let's start with the core issue, the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this number has fluctuated, but for decades it's been pushed unnaturally high, making silver look cheap relative to gold. Hunt believes that artificial distortion is now reversing and not gently. He describes the current stage as contagion, the phase where a market move stops being orderly and starts feeding on itself. At its recent extreme, the ratio hit around 126. That's not just high, that's absurdly high by historical standards. Then something important happened. The ratio slipped below a key level near 65. And that move wasn't random. According to Hunt's technical work, it triggered a massive reversal pattern that's been forming for years. A classic head and shoulder structure, the kind technicians watch closely because when it breaks, it rarely whispers. It shouts. Based on that structure alone, the ratio could fall to around 32. But Hunt doesn't think that is where it ends. He is projecting something most analysts would laugh off at first mention, a drop into single digits. Think about that for a second. Single-digit gold to silver ratios sound like ancient history, not a modern financial system full of algorithms and central banks. Yet, that's exactly why it would be so disruptive. Run the math. If gold is trading at $3,000 an ounce and the ratio falls to 9, silver would be priced north of $330 an ounce. And that's before you factor in what Hunt considers the real danger zone, the overshoot. Markets, especially late-stage bull markets, don't stop at reasonable levels. They overshoot, panic, and then overshoot again. Hunt suggests that while people may talk about $300 silver, reality could push prices to $500, $1,000, or even $2,000 in traditional monetary terms. This isn't said with hype or theatrics. Hunt's tone is calm, almost unsettlingly so. He's not pitching dreams. He's describing patterns. He studied how silver bull markets end, and they don't conclude with a neat bow. They end in parabolic chaos, where prices detach from logic and reason, and where fortunes are made or missed in a very short window of time. Here's where most investors get it wrong. They think the hard part is buying. It's not. The hard part is holding. Hunt talks about what he calls the law of the parabola, a concept many traders intellectually understand but emotionally fail to respect. In a parabolic move, the majority of gains occur at the very end. The final 5 to 10% of the price move can account for as much as half of the total profit. Let that sink in. Half the money is made right at the end when prices look ridiculous, headlines sound insane, and everyone around you says, "There's no way this continues." That's usually when it does. And that's also when most people sell. They see silver hit $100, then $150, then $200, and they feel smart locking in profits. Then they watch stunned as the price keeps climbing without them. Hunt isn't just focused on charts, though. He's deeply concerned about supply. And this is where the story shifts from technical analysis to something far more structural. Around 60 to 70% of the world silver supply is produced as a byproduct of mining other metals. That means silver production doesn't simply ramp up because the price rises. It's tied to copper, zinc, and other industrial mining decisions. Now, layer on top of that the emergence of new technologies, particularly solid-state batteries. Hunt warns that these technologies could potentially consume the equivalent of 100% of today's global silver production. If that happens, there's nothing left for solar panels, electronics, medical uses, or investment demand. Zero. And unlike paper contracts, physical silver can't be conjured out of thin air, no matter how creative the financial engineering becomes. This is why Hunt believes the shortage has already begun. Quietly behind the scenes, most investors holding silver today have no idea how tight the market could become. And when shortages go from theoretical to real, pricing mechanisms tend to break. That's when premiums explode, availability disappears, and price discovery turns violent. At this stage of the cycle, Hunt admits something that should make anyone paying attention pause. He says he's no longer sure what the word dollar will even mean by the time this move finishes. whether it's a traditional dollar, a digital version, or something else entirely. He believes the silver story is intertwined with a broader breakdown in the monetary system itself. Silver isn't just moving higher because it's undervalued. It's moving because trust is eroding. Naturally, investors ask the same question over and over. Is it too late? Hunt's response cuts through the noise with brutal simplicity. If an asset is heading toward $200, does buying it at $80 really seem expensive? The silence that follows that question is usually telling. People obsess over perfect entry points while ignoring the magnitude of the potential move. Yes, silver charts on longer time frames look stretched. Yes, pullbacks are hard to find, but Hunt argues that waiting for textbook entries during a structural breakout is often a recipe for missing the entire move. He's seen this play out before. People wait, prices run, fear sets in, and by the time they're convinced, the risk has multiplied. What Hunt is really warning about isn't just price, it's behavior. Human behavior doesn't change even when markets do. Fear, hesitation, early profit-taking, and disbelief repeat every cycle. The irony is that the very things that make people cautious are the same forces that drive parabolic endings. So, where does that leave us now? According to Hunt, we're not at the finish line, we're barely out of the starting blocks. The drop below the key ratio levels was the signal. Momentum is building, supply constraints are tightening, and the crowd is still debating whether this is real. Historically, that's exactly how the biggest moves begin. Whether silver ultimately hits $300, $500, or something far beyond that, the real takeaway is this. The market is setting up for a move that won't feel comfortable, rational, or orderly. And by the time it does feel obvious, the opportunity will already be far more expensive. This isn't about panic or blind optimism. It's about understanding where we are in the cycle and recognizing that the most dangerous moments in markets are often the quiet ones right before acceleration. As Hunt sees it, the question isn't if silver moves higher, it's just how prepared you are mentally to write a move that most people want to believe until it hits already gone. One of the biggest mistakes people make when markets start moving fast is believing there is only one moment to act, one perfect price, one magical entry that comes and goes forever. Francis Hunt takes a very different view. He explains that markets don't move in straight lines even during powerful bull runs. They breathe, they surge, pause, pull back, then surge again. And if you understand how to read multiple time frames, those pauses become opportunities instead of excuses. Hunt emphasizes that using multiple time frames isn't about complexity for the sake of sounding smart. It's practical. When the long-term trend is clearly up, the shorter time frames almost always offer small pullbacks along the way. He's not telling people to smash the buy button at any price and hope for the best. He's teaching them to zoom in, to stop staring only at the monthly chart, and to look for those micro pullbacks that happen inside a much larger move. To prove the point, he pulls up his actual trading platform. Not a demo account, not a hypothetical example. This is the same platform where his own money is at risk. He scrolls through Bitcoin, gold, silver, all trending higher, and he reminds the audience of something painfully familiar. Throughout this entire move, people kept saying the same thing. That's the top over and over again. And yet the market kept doing what markets do when they're not finished. So what did we actually get? Hunt asks almost rhetorically. The answer is simple. We got re-entry opportunities. On the daily chart, silver dipped twice within the broader uptrend. Small moves, nothing dramatic, but those dips were enough. He points them out clearly, explaining how he entered at those levels, placed stop-loss orders just below the relative lows, and let the market do the heavy lifting. This is what he calls his HVF approach, his personal framework for trading macro bull markets through shorter time frames. It's not flashy, it's disciplined, and it's effective. As price moved higher, those stop-losses were adjusted upward, locking in profits and reducing risk. New entries were layered in. The result, positions already sitting at roughly 150% gains, others over 300%, and the trend still pointing higher. Hunt is quick to stress that this isn't luck, it's structure. Volatility, in his view, isn't something to fear. It's the mechanism that creates opportunity. Every time silver pulls back, or $10, that's not the market failing. That's the market offering another seat on the ride. Most people miss it because they're zoomed too far out, staring at silver OS move from 30 to 80, and convincing themselves they relate. Meanwhile, professionals are doing the opposite. They're zooming in. They're watching the hourly, the 4-hour, the daily charts. They're identifying zones where risk can be controlled and reward can be substantial. Same market, completely different mindset. Then Hunt takes things further back in time. And this is where the room usually gets very quiet. He pulls up a quarterly chart of silver that stretches all the way back to the 1950s, 75 years of price action. On that chart, he highlights what he describes as a squeeze within a squeeze. A compression so tight, so prolonged that when it finally releases, the move isn't gentle, it's explosive. He explains that the technical evidence for a major silver move had been building for years, and the initial breakout was one signal. But then, something even more interesting happened, what he calls a gift within a gift. Markets often do this, he says. They give you the breakout, then they come back, just enough to let disciplined traders position themselves with extremely tight risk before launching again. Hunt has a unique way of talking about markets. He doesn't describe them as enemies to fight or puzzles to outsmart. He describes them almost affectionately. Now, the markets love you, he says, half serious, half smiling. His point isn't mystical, it's behavioral. Opportunities are everywhere, but most people walk straight past them because they're distracted, fearful, or convinced it's already too late. He compares market participants to blind creatures walking over pearls, gold, and diamonds, never bothering to look down. The value is there. The market is offering it. You just have to pay attention and be willing to bend down and pick it up. That squeeze within a squeeze activated around the $25 level with an incredibly tight stop loss and a long-term price target, around 333. But Hunt is very clear about one thing. That number isn't the end, it's a checkpoint. A place where price may pause, consolidate, and let the market catch its breath before the next leg higher. He's already structured his position accordingly. About half is held with the intention of taking partial profits when appropriate. The rest is left to run. No panic, no prediction of an exact top, just a willingness to let the market decide how far it wants to go. This, Hunt explains, is one of the clearest differences between amateurs and professionals. Amateurs ask, is it too late? Professionals ask, where's my next entry? Amateurs see a rally and feel excluded. Professionals see the same rally and find multiple ways to participate. The move, Hunt says, has started, but it's far from finished. Then he shifts to what he believes is the most misunderstood part of the entire silver story: supply. He pulls up a long-term gold to silver ratio chart stretching back decades. The ratio has been elevated for an unusually long time, and Hunt asks the obvious but uncomfortable question, why? Zooming further back into the 2000s, then the 1960s, he points out something unsettling. Silver has become increasingly financialized. Its price has been managed, suppressed, distorted relative to gold. Historically, the gold to silver ratio lived within natural ranges. Ancient Egypt saw ratios near 8:1. Other periods saw 10:1, 12:1, even 15:1. These weren't anomalies. They were the norm. What was never normal was a ratio staying above 100 for extended periods. That's a modern phenomenon. Hunt explains that this suppression was possible because there appeared to be abundant above-ground silver inventory, vaults full of metal ready to be mobilized to keep prices in check. But here's the problem. Much of that inventory isn't what people think it is. If silver isn't stored securely within your own jurisdiction, Hunt argues, you don't truly own it. Leased silver, rehypothecated silver, paper claims on silver, that's not the same thing as accessible physical metal. And evidence suggests that much of this supposed inventory either does not do T exist in usable form or can be mobilized quickly. As that illusion fades, the real shortage becomes visible, and that's when things get uncomfortable. The production side makes the situation even worse. Hunt slows down here, making sure the audience understands the gravity of the point. Between 60 and 70% of global silver supply comes as a byproduct of mining other metals: copper, zinc, lead, gold. Silver is often just along for the ride. That means only about 30 to 40% of silver production comes from operations that are actually focused on mining silver. This creates a serious problem. When silver prices rise, supply doesn't automatically respond. A copper mine doesn't T its suddenly double production because silver hits 100. They don't remine copper. Silver is incidental. So while demand is gearing up to surge, supply is effectively capped. And demand isn't just rising slowly, it's preparing to accelerate. Electric vehicles, solar panels, smart grids, advanced electronics, and now solid-state batteries. Everything needs silver. Hunt jokes that we're already moving toward the iPad car and the iPad everything, and he's not wrong. Solid-state batteries capable of powering vehicles for hundreds of kilometers and recharging in minutes require significant amounts of silver. As this technology scales, demand could overwhelm existing production entirely. That's the imbalance Hunt is warning about. Exploding demand, inflexible supply, and a price mechanism that hasn't yet adjusted to reality. When it does, the move won't be subtle, and by the time it feels obvious, it may already be too late to get comfortable entries. Let us pause for a moment and talk about the part of this story that truly changes everything, because this is where the silver conversation stops being interesting and starts becoming uncomfortable. The new generation of battery technology everyone is excited about, especially solid-state batteries, is being marketed as the breakthrough that finally makes electric vehicles faster, cleaner, and more efficient. Longer range, faster charging, better performance. Sounds perfect. Except there's a catch, and it's a big one. These batteries require enormous amounts of silver. Francis Hunt lays this out calmly, but the implication hits like a hammer. To supply just a fraction of these next-generation batteries, roughly 20% penetration into the market, you would need the equivalent of 100% of today's global silver production. Read that again. All of it. Every ounce currently being mined would be swallowed just by batteries alone. That leaves nothing. 0 silver for consumer electronics, 0 for solar panels, 0 for medical devices, industrial uses, or investment demand, 0 for anything else, and that's not hyperbole. Solar energy alone already consumes vast amounts of silver. Every solar panel relies on silver paste for conductivity. Now consider how aggressively the world is rolling out solar infrastructure. Entire nations are building it at scale. Layer on top of that smartphones, laptops, medical equipment, military hardware, guidance systems, heat-resistant applications. Defense industries, Huntes are exceptionally good at turning silver into high-heat technology. And none of this demand is optional. This isn't luxury consumption, it's structural. At this point, the supply and demand equation isn't strained, it's shattered. We're moving into a scenario where demand could be 5 times current production, maybe 10 times, possibly even 20 times. And here's the part most people miss. Supply cannot respond quickly, no matter how high prices go. You can't spin up a new silver mine the way you open a coffee shop. It takes years of development, regulatory approval, infrastructure, and billions of dollars in capital. Even then, many silver mines have struggled to be profitable because silver prices were suppressed for so long. Hunt explains it bluntly. Digging silver out of the ground takes a tremendous amount of energy, and for decades, the price simply didn't justify the effort. Silver was too cheap for too long. Now, the market is preparing to correct that mistake, and it's not going to do it politely or gradually. It's going to do it all at once. This is why Hunt isn't calling this a normal bull market. He's describing a historic supply shock where price becomes the only mechanism left to ration demand. When there isn't enough metal to go around, price has to rise until something breaks, until demand is destroyed or delayed. That's how markets resolve shortages. And resolve it, they will, by driving silver to levels that sound absurd today and obvious in hindsight. The shortage, Hunt argues, is no longer hidden. It's simply ignored. And those who understand it aren't waiting for headlines or official confirmation. They're positioning now quietly behind the scenes. The broader market realizes there isn't nearly enough silver to meet what is already coming, let alone what's planned for the next decade. But once you accept that premise, the most difficult question emerges. Not when to buy, but when to sell. This is where most fortunes are made or lost. Hunt addresses it directly because he knows this is where emotions take over. When do I exit? That's the question everyone wants answered, and the answer isn't a nice round number. Hunt explains that silver shouldn't be exited based on price alone. Not at $100, not at $300, not even at $500. The real signal is the gold to silver ratio. The same ratio that set this entire move in motion will also tell you when it west nearing completion. He believes that ratio will ultimately collapse into single digits, and when it does, that's when the final phase begins. The phase where discipline matters more than intelligence. This is where Hunt brings back the law of the parabola. In exponential moves, the bulk of profits appear at the very end. The final 5 to 10% of the move can deliver half of the total gains, but that's also when everything feels wrong. By the time silver reaches $200, $300, $400, every instinct you have will be screaming to sell. The media will call it a bubble. Friends will tell you you've been lucky and should cash out. Family members will urge you to protect what you've made. Then silver will pull back 15 or 20% and panic will creep in. That's it. People will say the top is in. And that's exactly where most investors make their biggest mistake. Hunt warns that these pullbacks aren't exit signals. They're part of the process. Professionals don't liquidate everything. They scale out typically around 50%, enough to lock in gains and remove emotional pressure while letting the rest run. Hunt maintains that the $330 area will be important, but he's very clear it won't be the peak. It's a pause, a consolidation zone where weak hands exit and strong hands add. What follows that, he believes, is the move that shocks even seasoned investors. Then he says something that cuts deeper than price targets. By the time silver reaches those levels, he's not sure what the dollar even represents anymore. Whether it's a paper dollar, a digital dollar, or something else entirely, the move in silver won't be happening in a healthy system. It will be happening because something fundamental is broken. That's an uncomfortable truth. 4-digit silver doesn't mean everything is going great. It means the financial structure that kept silver suppressed has collapsed. Above-ground inventories are gone. Byproduct mining has proven insufficient. Physical metal is scarce, and the world is scrambling to secure it at any cost. Hunt's final chart, the long-term quarterly structure going back to the 1950s, shows decades of compression, energy building like a coiled spring. And when those structures release, prices don't drift upward, they explode. According to Hunt, that release has already begun. The breakout is confirmed. Momentum is accelerating. The contagion phase is active right now. His message to silver holders is both encouraging and sobering. Encouraging because the setup is nearly perfect. Cautionary because the real gains are still ahead, and selling too early will haunt people far longer than holding through volatility ever could. Silver doesn't end its cycles calmly. History shows the final stage is chaotic, emotional, and fast. When the end finally arrives, silver won't politely give everyone time to exit. It will surge, crash, surge again, and then reverse hard when optimism reaches its peak. But Hunt doesn't believe that moment is imminent. Not this month. Probably not even this year. He sees this as a multi-year movement that permanently reshapes the precious metals landscape. His closing guidance is simple, almost poetic. The market wants to reward you. The gifts are there. The pullbacks, the uncertainty, the moments when fear dominates the headlines. All you have to do is stay alert, stay disciplined, and be willing to pick them up while others panic. The roadmap has been laid out. The technical structure, the supply crisis, the demand explosion, the entry strategy, and the exit framework are all on the table. Now, it comes down to choice. Do you have the patience to hold what feels uncomfortable today because it may become invaluable tomorrow? Or will you look back years from now and say, I knew silver was going higher, I just didn't stay in. The clock doesn't stop. Silver doesn't wait. The train is already moving. The only question is whether you're on board or standing on the platform watching generational wealth disappear into the